Good evening, everyone, and hope all of you are safe and well. On behalf of the Edelweiss Mutual Fund team, welcome to what I think will be a very special evening to discuss all things technology, and probably a very good time to be having a discussion on technology. Now, before I unveil what's ahead, many of you who know me know that I like to tell stories. So perhaps I'll start this event a little differently with a story back in the day. And this is a story from 1939, Princeton University, when Professor Albert Einstein was handing out exam papers to his final year class. And one of the students told him that, so these are actually the same questions as last year. And in reply, Einstein said, but the answers are different this year. And to me, I think that analogy expresses the state of innovation and technology today. Now, when we talk about words like innovation, we associate them with things like AI, disruption, robotics, Metaverse, Web3, et cetera, et cetera. But innovation isn't just tech stocks, robotic stocks. It's really everywhere. Innovative companies are in many sectors impacting how we design and administer medical treatments, the way we work, the way we socialize, the way we live. And these terms are not new to many of you. We at Edelweiss launched the US Technology Fund exactly 2 years back. In fact, this event probably coincides with the 2-year anniversary of that. And as many of you know, that feeds into the JPM US Tech Fund. Since the launch of this fund, of course, the India fund industry and all of you, our distribution partners, investors, have got a lot of exposure to the topic of technology. We get a lot of questions about it. And so today we thought we'd like to discuss with you what innovation means, how we think about investing in innovation, and how we should be benefiting from it in the times to come. Before I talk about our speaker today, because I know you didn't log in to listen to me and my stories from 1939, I should also address the elephant in the room about US technology. And a question that many of you have had about flows into this fund. Like many other peers in the MF industry, we have had to close flows temporarily in this fund because of a breach of industry-wide RBI limits. But we are very optimistic that those flows will open sometime soon, very soon, I hope. And as soon as they do, the fund will be open for subscription again. So before I come to that, I thought, let me just take that question. And now I'm actually joined by someone who has been covering innovative technology and tech-enabled businesses for almost 2 decades. Joe Wilson, who is the portfolio manager of the underlying fund, that's the JPM US Technology Fund. He's been the portfolio manager since 2014. Today's format is, I think, I have a bunch of questions for Joe about his journey, how he thinks about technology, some of the themes going forward, and then we'd be more than happy to take your questions. So please keep the questions coming, put them in the chat window, and we'll take them later during the course of the session. With that, Joe, thank you for joining us today. I understand you're in a very cold location, and I also understand that you're doing this for us at 6:30 in the morning. So thank you very, very much.
It's a pleasure to be here. I'm so happy to be able to speak with you and speak with investors in India and all around. So thank you for the time.
So Joe, my opening question is, and I think it's a fascinating career because you've had the chance to cover technology over so many changes. Now, in your sort of career covering technology and investing in tech companies, how has this space evolved as you see it? And what does it mean for investors today?
Yeah, technology has evolved dramatically just in the 20 years that I've been covering it. But I almost think that what is the more important question here is and focus point is the fact that technology will continue to evolve and it will continue to disrupt. And this slide that we are showing right now, it's my favorite slide. Usually when I speak with investors, I'll have a slide deck of 20 or 30 slides to go through, and I usually just stay on one. And it's this one. And the reason why is because this teaches us and shows us that following tech and disruption and innovation is extremely important from a shareholder return perspective. So as we went through, if we start in 1980 and we kind of think of that era as the mainframe era, there's a list of companies below that that include Kodak, Hewlett-Packard, Texas Instruments, Motorola. These were all companies that benefited dramatically from the adoption of mainframe. But what we see is as we go into the next era and the era after that and the era after that, the market cap leaders change dramatically. Some of the companies that were leaders in 1980 don't exist anymore. Some of them only hung on for one more era. And now as we've stepped through from mainframe to PC to internet to mobile cloud, we're at the onset of a new era, which is we think will be defined by AI. But maybe when we look back in 10 years, we'll call it Metaverse, or we'll call it VR or AR or something else. Mm-hmm. But what we know for sure is that at the principal foundation, it's artificial intelligence. And what we think happens here is we see another dramatic shift in market cap leadership. And I want to point out, because I think this is really important, it's very difficult for the largest companies to stay at the top of this list. And that's one of the other very important lessons, which tells us and informs us that when we do our work and when we're thinking for disruption and innovation, we need to look lower on the market cap list. And it might be a company that's 2 billion or 3 billion. It might be a company that is private. It might be a company that is at the top of this list in 10 years that doesn't even exist today. And that's how fast disruption can happen within technology. And it's not to say that these companies that were leaders 10 or 20 or 30 years ago are bad companies. But what it means is that they're either they lost their market share or their market became irrelevant. Mm-hmm. I think IBM is like the prime example. IBM is still hanging around. It's just that nobody really cares anymore. They're still the leader in mainframe compute, but mainframe compute adoption just moves with cycles, and retention is very low as things have moved to PC and now are moving to the cloud at a rapid pace. I think, yeah, I wanted to touch on this other side as well too. The one very important aspect that I think is also necessary to understand is that technology invention used to be something that was created and then sold to every single industry, right? So when IBM was selling mainframes, they were selling it to hospitality or airlines or general enterprises. What we're seeing now is that more innovation and disruption is impacting every single industry in a different way. So companies like Tesla, for example, within auto, they bought many off-the-shelf solutions, and they were benefited from cloud hyperscale infrastructure such as AWS. But they also invented and developed many of their own software solutions for AI and autonomy and for fleet management. These aren't solutions that they're selling to other auto OEMs. They're harnessing this innovation and technology to disrupt massive brand new markets that were largely untouched for all the previous eras. And this is one of the major drivers of AI. So just as Amazon disrupted retail and Tesla is disrupting the auto industry, we see a handful of players that are going to disrupt every other market, right? At the top of the list, we have energy. One of our favorite companies in the portfolio, Enphase, reported last night and blew away numbers. They make a microinverter for residential solar. And if we continue this evolution and idea of disruption within clean energy, there's the future potential to have every single residential home in the world running off its own private grid. And behind that requires not just microinverters and solar panels and batteries, but a really intelligent software solution to handle different power solutions. But we see this impacting industrials and autos, financials. Healthcare, I think, is we're at the very, very beginning of what is going to be an exciting era for disruption in healthcare as we go into molecular identification using large data sets, machine learning, and cloud. This is, I think, going to provide specialty care on an individual basis. I'm really excited about that because it also benefits society in a very major way. Consumer, I think, is very obvious today in terms of, I mean, it's funny how easy we begin to accept things. And so thinking of like 2-day delivery or ordering online is like, you know, nothing to us now. It's all very well expected. But imagine 10 years ago, ordering everything in your house online and expecting it to be there, you know, within 2 days or what, like that idea was not even plausible then. And then I think media is really exciting. There's still so much content and infrastructure that is being managed today for traditional over-the-top TV. And we see an era that is, or for traditional cable, we see an era that is going to be very well defined on streaming, on not just into the living room, but on VR headsets, which maybe removes the TV from the living room. We see a shift towards gaming that is going to be streamed from the cloud. So we think media and entertainment is also really ripe for disruption. There's still a huge allocation of ad budgets that are still going to traditional TV that we think will come over to streaming and benefit a handful of players as well.
Thanks, Joe. And I think you make 2 points. I think one, you talk about how technology is prevalent across industries. And, you know, I also want to emphasize the point you made on the previous slide of how winners in tech keep changing. And that brings me to my second question, which is, you know, obviously passive investing has taken off globally, you know, but with the nature of tech investing, the fact that winners keep changing, that you have to look across market caps, you know, why do you think active investing still makes sense in the context of technology?
Yeah, I think active investing is what keeps us on pace. It keeps us actually ahead of pace for large returns. And you know, if I look at, you know, like the QQQ, for example, you have 30% of your market cap weighting in 3 companies, Microsoft, Apple, Amazon, that have already won. Like they've, granted, they'll put up, you know, decent returns, and we own those in our portfolio. But the companies that we have made that have driven our performance haven't been what people identify as the leaders today, right? So our benchmark isn't a market cap weighted; it's an equal weight index. Every company that we look against, it has around 70 basis points, and it resets quarterly. But that being said, I understand that people look at other benchmarks, whether it's XLK or Nasdaq. And I think what's really important here is that our approach to investing, and I think the active approach to investing, is to take rifle shots, to take bets, and decent sized bets on companies that we believe are going to overthrow these future, you know, the current market cap leaders and become the leaders of the next era. That's not, it's easy to say, it's very hard to do. But we have a really good history of doing this, right? I think back to listening to Jensen in our office. He's the CEO of NVIDIA, came in 2015 and was talking about deep learning and training and AI. And he had been talking about using like machine learning in the past, but it never came to fruition in terms of actually supporting the fundamentals of his stock, right? Or of his company. And so I started doing more work on it. And I actually, the very first, the initial reason I got so excited about NVIDIA was because my son, who was 3 at the time, was in our kitchen. We had just bought a new Alexa device, an Amazon Echo. and from Amazon, and he asked it to play a song, and Amazon Alexa said sure, and started playing the song. And I thought to myself, is like, how did Alexa understand what my 3-year-old just asked it when Siri hasn't been able to understand anything I've been asking it for the last 5 years? And so I started digging deeper into what infrastructure Amazon was using, and then I started to understand more about deep learning, and that they were using GPUs across massive data sets to train their voice recognition. And that's when everything kind of clicked for me, is that using that for the very first time, computers can now see and they can hear. And so we had multiple conversations with Jensen after that 2015 meeting. We actually invited the head of Google Brain to come in, Greg Corrado, to teach us about how Google was using deep learning. And he showed us a chart that looked kind of like the chart on this page, but it had an exponentially just up increase in demand of workloads for machine learning and deep learning. And after the conversation, I said, what type of infrastructure are you using? He's like, well, there's no other option. It's just NVIDIA GPUs. And that gave us the confidence not to make NVIDIA a 1% bet in the portfolio, but a 3.5% bet in the portfolio. And NVIDIA since then has been a magnificent stock. There's many examples like this. So whether it's Shopify coming in and testing the waters meetings and understanding that this is going to be a huge company come IPO and maturity, or the Trade Desk and the disruption that they were driving for advertising across the programmatic stream, including streaming TV. Enphase, so many companies that have been the biggest returners for us. Of course, we love to see Apple and Amazon and Google perform, but it's more fun. But those aren't the stocks that are going to double or triple over the next 2 or 3 years. It's these smaller, less understood companies.
And I think, if I take, and Rohini, if you can flip slides for us, I think the long-term performance of this fund, gives you the evidence, by the way, that there is merit in active management in technology. I think one thing we always talk, it's easy to look at short-term numbers, but I think on a rolling 3-year basis, the fund has almost always, or always actually, outperformed the Nasdaq. And I think in the last 4 calendar years, 3 out of 4 have been Nasdaq beatings. So the long-term track record, also suggests that, there is serious merit in active investing in the tech space. Now, Joe, I want to go back to, a theme you picked in the first question, which was about AI, and that being the theme. The past 2 decades have been transformative. There was the internet in 2000s, cloud in the last decade. What are the themes? Could be one theme, could be multiple themes that you think might define the next decade, the 2020s?
I think underlying all of these themes, there is a strong current of AI and machine learning. And I can go through every single industry and talk about the benefit to them because of AI. Mm-hmm. Whether it's advertising, I think of the social networks, and today they take signal from things that we click on, the groups that we subscribe to, the network of friends that we have or interests. But what they aren't mining yet fully, I think they are mining some of this, are the constant amount of pictures and videos that are being uploaded on a daily basis that tell somebody so much about yourself. And I actually, 6 years ago, this was one of the, I talked about NVIDIA before, but this was one of the use cases I thought of for a company like Facebook or Twitter or Instagram, which was, if I took a picture in front of my house and they can understand, the car I have in my driveway, or assess how old it is or the color it is, that might be very informative to help an advertiser, whether it's Ford or Chevy or Tesla, target me with an ad that specifically identifies the color, that has the color of car that I like, or know when to show that ad because they can assess the age of the car. They can tell things about my family, or the colors I wear, or the types of shirts that I wear. So I think there's so much more information that is available, within advertising now that computers can see and hear for the very first time. I think of the auto industry and autonomy and what Tesla is doing to produce a car that can drive from all the way from your home to work with just the click of a button. I think we're still a long ways there, but some of the magic is starting to show already. Just like the iPhone, I think, has evolved over the last 12, 13 years. I think we're going to see a pretty steady evolution in autonomy. But this all requires, the million cars that Tesla has on the road today that have 8 cameras that are constantly recording video and uploading it to the cloud to teach the master algorithm, to inform a master algorithm that is able to navigate not just my driveway, but how to take right turns when somebody is walking a dog onto the right side of me and do that safely, or to be able to identify when a car is maybe has the emergency lights on, but is parked too far into one of the driving lanes, and to slow down and go around. It's a very complex set of examples, but Tesla, the reason why I believe nobody will beat Tesla from this point forward on autonomy is because they have such a massive lead in terms of the fleet and amount of video that they're bringing in. And so I think maybe one of the most interesting, and I know that a lot of people kind of laughed at this, but when Elon at one of his Tesla analyst days showed his robot, I actually thought, that it's not that different than how he's teaching a car to drive autonomously is teaching a robot to perform simple tasks. And these might be tasks that are very laborious tasks, lifting up a pallet of steel to put into a press for a manufacturing job. I could envision many different areas within his own factory where he could benefit from autonomous robots. But I think that could drive massive adoption of manufacturing and onshoring to many local countries, where right now we depend on import. So that's a huge opportunity on a global basis, especially as demand is so high right now and supply is obviously coming under pressure. And I think that this might be a potential relief valve. The other area that I think is extremely interesting, and I oftentimes just think about, like, what are the things in my life that are kind of terrible experiences that could be improved dramatically? I think financial systems and fintech is ripe for adoption. I think of a small business trying to get a loan that might take multiple weeks of providing stale and delayed information to a bank for the bank to get a good financial picture of you. I think it will be obsolete in 5 years, right? With companies like Square or Shopify being able to see your daily financials and understand the trends of your business, not only may they be in a better position to provide a loan, they might know that you need a loan before you even know you need a loan to help accelerate your business. And I think that is very AI machine learning driven workloads as well too. And then the last one I'll talk about, which I mentioned before, but in healthcare, not only from a providing therapies and identifying new drug formulations, but the healthcare process generally is not great. It's not a great experience. And there's such an underserved population because of the increasing prices. But I go back to one of the very first use cases that Google used their deep learning image recognition on was diagnosing diabetic retinopathy, which is the leading cause of preventable blindness around the world. And this is a simple scan of the eye that then took a very specialized doctor to identify a disease. Well, computers now can identify the disease in a fraction of the time with the same or even better accuracy level. So not only does that improve the cost for people that have the availability to have that type of scan today, but it extends the opportunity to new continents. I mean, Africa, it has many, many cases of diabetic retinopathy that go undiagnosed and cause blindness. This is a very simple way to serve a market that they didn't even think healthcare was bad. They had no healthcare in certain geographies. And this is an opportunity to benefit, I think, the world in a much larger way.
Joe, since you spoke of AI, I want to talk about something that's, a word that's been buzzing. I mean, Satya Nadella has talked about it. Zuckerberg's talked about it. Everyone's talked about how Metaverse is the future of the internet. Facebook was rebranded. That's a separate question altogether. But I have two questions. I do want to ask you what your thoughts on this theme are and where you see the investment opportunity. And maybe in a few lines, it'll be great if you could also explain Metaverse, because at least for a lot of people like me, I haven't heard a great explanation of what Metaverse actually is.
Yeah. Well, I think that's because Metaverse can mean many things to many people. And I don't think that we have a Metaverse definition yet, to be quite fair. Just as maybe 20 years ago or 23 years ago, when the web was still forming, we didn't understand the full concept of what it would allow us to do and how we could serve each other and build businesses. But there's a couple things I think are important to understand. One is that it provides access to a global network of participants, of people. I think that it includes a very large community of artificial intelligence robots that can help serve specific requests, whether it's recommendations or whether it's customer service. We don't know for sure that it's necessarily going to live in a VR world or an AR world. But if you've watched the movie Ready Player One, you think like that is the metaverse. But it could also be something closer to the movie Her, where Joaquin Phoenix has his phone on his chest, looking outward with the camera, and has an earpiece and has an AI bot talking to him continuously. It could be all of those things. I think what is exciting is that there's not one company to play for Metaverse today. Just as the web evolved over multiple decades into what it was initially on a few networked computers, to then hundreds of millions of PCs, to now billions of phones, I think we're going to see a very steady evolution towards this idea of the metaverse. And maybe the metaverse is the same thing as Web3, because I think Web3 is also an ill-defined term as well. But the things that will change are going to be consumer behaviors. On the previous slide, I had cryptocurrencies and NFTs. I think broader adoption of new technologies can drive these other alternatives and appreciations of different assets for consumers, right? Just as it was hard to imagine 10 years ago that we'd be walking around taking pictures of ourselves constantly, or streaming video. Like, if you would have told somebody a decade ago that the world's going to be streaming pictures of themselves, they would have been like, you're nuts. It's not going to happen. Just as like if you would have told people 20 years ago that everybody's going to be walking down Madison Avenue with their head down and a phone in their hand. Like, these are things that seem just like impossible or very unlikely. But maybe in the next 10 years, one of those ridiculous aspects of people saying there's no way I'm going to walk around with these big goggles on actually becomes a reality. And maybe the goggles aren't as big as they are today, which we're pretty confident in as well too. So I think there's this mix of multiple aspects. But here's what's really important. If we go to the next slide, is that we don't have to buy one company that's going to be, we don't have to put all of our bets into one company that we think is going to be the metaverse company, because it's going to require multiple different pieces of infrastructure to build this into what it could be. Behind it, AI for sure, and machine learning. And so we think of companies like AMD and NVIDIA, also extremely graphically intense. So, rendering new worlds, if it is VR or AR, is going to be extremely important, just as it's extremely important today if you're playing a game of Fortnite or if you're playing on Roblox. And so the trends that we're playing AMD and NVIDIA for today also extend into that potential futuristic world. The infrastructure on networking and cloud is going to be onerous, because now you're not just using your bandwidth for a time delayed upload of a selfie or a download of a quick video. You're uploading and downloading really graphically intense images, and that requires new networking capabilities. That's why we're really excited about Marvell. It's why we've looked at many other companies in the networking space that we're pretty excited about, and we think that that's a trend that's going to happen, adoption trend that's going to happen sooner rather than later. We think of the advantages that Snap has had in this space for a very long time. Snapchat is on the list in terms of virtual platforms. Just as Facebook might be a platform, Snap might also be a platform. But what's really interesting about Snap is that, they've been spending time and money and engineering talent on augmented reality heavily for the last 6 or 7 years, ahead of anybody else, right? So when you used to take the selfie and had a dancing hot dog in your background, you did that for fun. And that was something that would get smiles from your friends or enjoyment from for yourself. But what was really interesting during the pandemic is that they started to pivot that augmented reality into something that actually provided a more commercial use case. Estee Lauder, cosmetic companies were using the Snapchat's augmented reality platform to try on new makeup or polish on your fingernails. Nike was using it to, if you pointed the camera at your foot, you could try on some new Air Jordans. And so those all help to convert this appreciation for what was maybe a silly feature before to something that has more commercial aspects to it. Roblox and Unity, I think, is doing some very inventive things. They bought Weta Platforms, which obviously has a huge catalog of Star Wars-esque material that's now going to, and special effects that are now going to be provided back to a community of developers, which is really exciting. Not only is that going to have an opportunity in the metaverse, but it has an opportunity today to make just gameplay generally better. And then we think about companies that could benefit on the fintech side. Coinbase, obviously, has been a leader on in the exchange of cryptocurrencies, and maybe they have a place and an opportunity to convert from being just an exchange to more of a wallet where cryptocurrencies aren't just traded, but they're used to actually buy things, which is what we've been kind of waiting for to get more excited about crypto. And then there's a handful of other companies, but what's really exciting is that there's already, for anyone who's on this call or for yourself, if you haven't tried like the Facebook Oculus Quest 2 headset, try it. What's amazing about it is it's $300 US today. But the experience that you get from this headset at $300 versus just 5 years ago, it used to cost $2,000. The images were worse. It didn't have, you had to be tethered to a highly intense GPU. You didn't have good hand controls or motion control. It's incredible the amount of innovation and improvement that's happened in just a short time frame, which makes me extremely excited to see, I think, what we're going to see from Apple potentially the end of this year, but most likely next year for their VR, AR headset, and also the improvements that Facebook makes as well too on their hardware.
It's interesting, Joe. You touched on crypto, and blockchain and crypto have been a topic that's been buzzing in India. We are going to have our own digital currency, our own digital rupee soon. And the government's announced quite a bit of stuff on crypto assets. But how do you see this space evolving, specifically from a portfolio context? So do you see potential in the new technologies? Or is it just too early to look at them from a portfolio point of view? And this was my question too, and this was, actually one of the most common audience questions that I seem to be getting.
Yeah, I actually don't think it's definitely not too early to be thinking about it, and also thinking of those companies that could benefit the most from it. It's funny, I started at JP Morgan in 2014, and one of the first things I did with a portfolio manager on the growth platform, Giri Devapalli, and we hopped on a plane and we went out to California. We were meeting with many of the companies that we held in the fund, but we also did some private company meetings, and one of them was Coinbase, which is one of the largest cryptocurrency exchanges in the world, and the largest in the U.S. And ahead of that trip, right in end of 2014, beginning of 2015, can't remember the exact date, but ahead of that trip, I created a Coinbase account and I bought, I think, $3,000 of Bitcoin. This is when Bitcoin was priced at 250 or 300 US dollars. And we went out and we met with the COO and we talked over beers for about 2 hours about blockchain and about cryptocurrency. And we flew back to New York, and about a week in, I just kept thinking about this, and I was very much sold on the idea of programmable money, which I think is really what blockchain is. It is in a very simple definition. But I wasn't sold on the asset class of crypto because it required other people to believe that this could be a currency in the future. And so I sold my Bitcoin about a week after buying it, I think for a small loss, actually, which was maybe one of the worst financial decisions I ever made, because it's been up, I think, 100 or 1,000x since that meeting. But I actually learned a very valuable lesson about taking small bets on new emerging opportunities, which is something that I think informs our portfolio today. But the other thing that I learned as well too is because from following it that early and watching it so closely since then, is that it's maybe one of the most exciting opportunities to actually create massive disruption to financial services. If we think of how today a credit card transaction is processed with a Visa or MasterCard, there is 6 other parties in between the consumer and the vendor that are taking little fractions of that transactional price. And it's so opposite of how transactions used to occur, which was with an actual piece of paper where you would hand it to the vendor and he would take his share and give you back any change. And I think that is what cryptocurrency, the opportunity of crypto, along with blockchain provides. And blockchain is really the auditable distributed ledger of money, so that you can track it, you can program it. And then crypto is the currency, whether it is Bitcoin or whether it's a new crypto that's backed by a government, a regulatory agency, which is something that I think needs to evolve continuously. So it's great to hear that in India, the government is obviously supporting certain types of crypto assets. In the US, we've seen more of the heavy hand versus the uplift from a regulatory perspective. And so while it's allowable today, we don't have the full support or a roadmap for how the government is going to scrutinize any of these transactions. So right now, I think it's still early. I see lots of potential. Healthcare, which again is a terrible experience for so many of us, I think could be one of the largest beneficiaries of blockchain. If I go into a doctor's office, I don't even know what my final bill is for about 60 days. I feel bad for the doctor because he's not being paid for at least 90 to upwards of 180 days, because the insurance company needs to slice up how much they're paying. They need to take my money directly from me and then pay the provider at the end. And then the doctor, of course, then has to pay his staff, has to pay the hospital that he works at. So having a programmable way of saying, here's a transaction between a doctor, and Joe, here's the percentage of amount and that is covered by insurance, and to be able to then just pay instantaneously walking out of a doctor's office is something that I think would dramatically help improve multiple outcomes and understanding of what the true cost of healthcare is. So that's just one example. But yeah, I'm excited for it. I think just more broad, I'm excited for blockchain, true believer. On the crypto side, I think it still will take more time from a regulatory perspective to get a general support, I think, for me and for the fund and the portfolio generally.
By the way, we only have tax on crypto assets. We don't have a legal framework, so we're not that far behind. But so my last question to you, Joe, is that you've had a great run with this fund. It's one of the best in its peer sets. It's a 5-star fund by Morningstar. In your journey of running this strategy, could you summarize maybe 2-3 key learnings that could be useful to investors looking at the tech investing space today?
Yeah. I've been very fortunate to have a great set of mentors, and I'm very, I'm constantly assessing my own capabilities and questioning them. I think being a good investor requires that introspection into oneself and learning and evolution, just as we've seen in tech. But surrounding yourself with other great investors is usually very helpful. And I've been blessed that I've had many great investors to work with and for over a long career. And maybe the most, as I look back at some of the things I've learned, maybe the most important is just the way that we assess risk in the portfolio. And when I first started in this industry, I needed to figure out a way to efficiently manage my time. And so I started to run a discounted cash flow on every company in the universe. Very simple DCFs, trying to think if everything was great for this company, what does the revenue look like? What does the free cash flow look like? And I would discount that back. And the ones that had the most upside were the ones that got the majority of my time. And when I moved to my next job, I had a portfolio manager who liked that framework, but also he was used to be a credit analyst, and he was very, very different than me, and I was more worried about the downside versus the excitement and upside of the stock. And so I started to take what I was doing in terms of thinking of like, if everything goes good for this company, if they take market or the market becomes larger, or their optionalities and XYZ hit, I used to do that same thing, but on the downside. Let's say this company misses the mark and they mishandle their opportunity, or their opportunity becomes obsolete. What does the downside look like in the stock? And I would model that back. And that gave me a better framework to appreciate risk and reward. And those two numbers really shouldn't change much at all, but what changes every single day is the price of that equity. And being able to marry that along with making sure that that doesn't stay stale, but moves with the market as well is very important. And that has helped us. It's funny because when we were looking at companies early on, whether it was NVIDIA or Shopify or even Apple back in the day, and trying to think of their upside case, we would have upside models that showed like 200 or 300%, which is like unheard of for many companies, but that was how the numbers looked to us. And then we would see, shortly thereafter that the companies would go through that. And so that wasn't for us a signal to sell it, but it was a signal for us to question, how are we thinking? Like, are we thinking correctly about this company? Can it be even bigger than what we thought was like the best case scenario? And I think that keeps us grounded. And what you've seen from this framework, I think through 2020 and 2021, is that there's been a much greater appreciation for a handful of stocks. Many of them happen to be software and cloud companies where the valuations approached levels that were our upside targets, and in many cases went through them. And so then we take that introspection and ask ourselves, like, what are we missing here? And as we do more and more work, it turned out we weren't missing much. It's just that the market was maybe getting a little too excited. And that drove us to sell a handful of these companies. Many of them happen to be software. And so that drove a large underweight in software. A lot of the companies we were finding extremely attractive were semiconductor companies and semi-cap companies. And that drove a large overweight into that segment. And I think that's been a very helpful way to assess risk in the portfolio. And now in this current stage that we're in, where the tech is generally selling off, we're seeing many of these mostly, the most well appreciated companies in that SaaS space that were trading at multiples that we had never seen before have come in 50%. They could come in another 50% as well too, which actually makes me very, very excited about the opportunity. And I know we might get questions about this current market dynamic that we're in, but the last point that I think is really important to pay attention to is that we can't get too caught up in the short term, right? And I always go back to this one example, but there's many from this time frame. But in 2007, Steve Jobs got up on stage and he showed us what the next generations of mobile handsets was going to look like. And it looked like nothing anybody had ever seen. And we were all very excited. And even that excitement nobody guessed that Apple would eventually sell 250 million of these in one single year. The market wasn't even that big for handsets in that price zone when it was introduced in 2007. But from 2007 to 2008, Apple doubled as a stock. Then we had the great financial crisis in the US, a lot of disruption that impacted financial services, but just generally the market was wasn't very healthy. Apple was cut in half. It was more than cut in half, all the way through 2009. And the takeaway from this is that even though that we could see how inventive and exciting the opportunity Apple had ahead of itself, the market still sold the stock off and didn't care one bit. The important thing about that time frame wasn't trading Apple at the right opportune time. It didn't mean that you had to catch the stock at the very bottom at the beginning of 2009 and sell it at the top in 2008. What made you a good investor was taking that longer term view, that 3, 5, and 10-year view, and make sure that you got the right stock, that enduring franchise, that company that's going to be around for a very long time and disrupt a massive market. And today, if you look at Apple's stock chart, I challenge anybody to do this. Take the dates away at the bottom. Show me the volatility in 2008 and 2009. You can't even see it. It doesn't even show up because Apple was such a successful story. There's so many others like Apple during that time frame, whether it was Salesforce or Equinix or many of the tower companies, many software companies that were then acquired later on, that had a very similar amount of volatility. And that's why I actually get really excited about times like now, where we have this opportunity to see people throw out companies regardless of the opportunity ahead. And maybe they were expensive, and maybe that's why they're not in our portfolio today. But this is our opportunity to upgrade the portfolio with those handful of companies that maybe we sold or trimmed back in 2020 when the market was fully appreciating these, and add them back in for really big long-term gains.
Thanks, Joe. And you gave a perspective on historical volatility. We have actually a ton of questions. We have 30 questions, which we're clearly not going to be able to answer in 10 minutes. But I'm going to try and take a few. And the first one is actually related, to what you spoke about. So you gave a perspective on historical volatility, and I've tried that Apple exercise, and you're bang on about it. But can you talk a little bit about current volatility? I think from an Indian investor point of view, they've, of course, seen a very, very volatile January. They're hearing a lot of noise about rising US rates, liquidity being withdrawn. So they're hearing a lot of macro US noise. They're seeing many of the companies that IPO'd in the tech space, actually in India and in the US, down 50, 60% from listing. So how do you see the recent volatility? I mean, overdue correction or overdone?
Yeah, so if we had been talking in 2020, I would have told you that we need to be patient because we hadn't seen the regular type of pullback in tech that we've seen generally every 2 years since 20 or the year 2000, which is, and my general way of just kind of assessing the amount of pullback is I'll just look at the Nasdaq relative to the S&P. And every 2 years since 2000, almost on that exact kind of 2-year date, you see a 6% sell-off in Nasdaq relative to the S&P. We are now in a pullback of close to 13% or 14% since the beginning of 2021, when we did see tech pullback. And I think the fact that we have a larger pullback right now makes sense. I mean, 2020 was an unbelievable year for the market and for tech specifically. It was like full-on appreciation for those companies that can keep the lights on and keep your customers happy and keep employees actively engaged, right? And Zoom is maybe, the platform we're on right now is maybe the best example of this. This was a company that entering 2020 was expected to grow, I think, close to 60%. They grew 400%. And the stock followed that as well, too. And so now we're in this period of like going back to normal or finding a new normal, which is most likely going to be a deceleration in growth for tech. And well, we've been talking about that we've been talking about it since the middle of 2020. And I think our portfolio is positioned to show that we had been kind of waiting for something like this. It still can always surprise you to the downside, just as things can surprise you to the upside. So I don't know that this is necessarily done in terms of a sell-off yet. I would expect definitely more like the same amount of volatility as we go through 2022. But what I would say is that the argument around rates is something that we always, 2020 was also the year that we were going to be lower for longer and rates were going to be at zero. But in our model assumptions, we didn't assume a 0% interest rate, just as we're not assuming a 5% or 4% long-term rate either right now. And so what we've always done is have a normalized approach to this, which I think keeps us grounded in terms of when markets get really excited, like they did a year, 2 years ago, and just as they're getting depressed now, which helps us to identify stock. There's no empirical evidence to show that tech does not work in a higher rate environment. But what we do know from experience is that when rates are changing, volatility will definitely hit a handful of the elite growth, less profitable companies, which is what we're seeing right now. Companies that are working are those companies that we typically don't have a large representation in the fund of, but it's companies like HP or Oracle or Cisco, companies that have been around for a very long time, have high free cash flow yields. But what we try to do is make sure that we're taking a barbell approach to making sure that we have a good amount of mature growth companies, elite growth companies, and then also that cyclical growth in the portfolio.
So, Joe, I want to ask you one last question, because I know you also have limited time. You've talked about the fact that big doesn't necessarily get bigger in tech. An investor is asking, can you throw a little bit of light on how you think about exiting companies in the fund? And then there's a second unrelated quick question that I thought you could take. Since so many Indian investors especially think of tech investing as Nasdaq, why do you have Russell as the benchmark?
Yeah, so I'd say in terms of exiting companies, we exit them for the same reason that we enter them, which is, or I guess for the opposite reason of why we enter them. When we're buying a company, the very first thing that we're doing is meeting with management team. We're meeting with private companies that compete with that company. We're meeting with experts in their field that understand the fundamental drivers of the company. The last thing we do is the valuation work on it, right? Because we want to know if a good company is good, should we be very excited about it? And then valuation comes into the mix, is like, is it also a good time to buy, right? Is the market underappreciating either the magnitude or the sustainability of growth that we project for that company over a long period of time. Usually when we sell a company, one of those two is not making sense anymore, or maybe both, which maybe means the strategy changed or the thesis has broken, or the other, which is that the market fully appreciates what we appreciated initially as well too. I would say when it's usually the latter around valuation, it isn't an exit. It's in it right away. It's a slow exit. It's where we can trim a company, because the very best companies will find ways to grow that opportunity, continue to surprise investors with new opportunities and optionalities, and we want to make sure that we give management opportunity to do that. So then the next case, or the second question was around the benchmark. We did a lot of work of trying to find a good benchmark for us, and that I think gave us an ability not to outperform, but an ability to think differently. And when you have a market weighted benchmark, whether it would be like the Russell market weight, or the S&P Tech, or something that looks like XLK or even QQQ, the problem is that you get caught up in trying to understand how much allocation you should have for these mega cap companies, right? And so I don't want a portfolio where if I'm excited about Microsoft, that I have to own 15% of that company, because that takes away from maybe 5 other bets or 6 or 7 other bets in smaller or mid-cap names that I think can provide an even greater amount of upside. And it's the same thing of thinking about Google or Amazon or Apple, which consume large portions of those benchmarks. And so having an equal weighted benchmark is really helpful in allowing us to not have to worry just about the mega cap companies, but allow us to think of who's going to disrupt these companies and who's going to grow faster and have a larger opportunity ahead of itself.
Super, thanks, Joe. I'm going to just take 2 quick questions in the next minute that are specific to Indian investors. So I'll take the opportunity to answer them. There was one question on the NAV of the fund, and sometimes, you look at the fund NAV and the Nasdaq NAV and they're not in sync. I just want to mention to investors that since the underlying fund here is a Luxembourg fund, it takes prices at the start of the US market. So if you have a day where the US market is low and then becomes green, you will see deviations. They get corrected on subsequent days, so there's nothing to worry about. Second, and I mentioned this at the start of the call, there are about 15 questions that came on why the fund is closed for subscriptions. I would just repeat again that it is part of an industry-wide closure to close funds because industry limits for foreign investment in securities have been hit. We are hoping that the RBI will open these limits very, very soon. And as soon as we do, we will open the fund up again for SIPs, STPs, and fresh purchases. And we really thank all of you for the interest and commitment both to this event and to the fund. Joe, it was a fantastic 1 hour. Thank you for taking the time, as I said, at 6:30 in the morning. We talked about so much, I think, innovation through the decades. I finally understood a little bit more about Metaverse. We talked about blockchain. We talked about the recent correction. And I think the learning really is that, innovation is the reality, adapting to changing consumer needs, navigating turmoil from disruptive players. It all needs innovation, and innovation will continue to create new opportunities. And as I said, hopefully the fund will open again very, very soon for subscription for new investors and for existing investors as well. So with that, thank you so much, Joe, for joining us. And thank you all very much for tuning in. I know we couldn't answer all the questions, so please send the questions into our team on social media or to your RM, and we'll do our very best to answer them. Thank you very much.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.